Now let's look at a decision that we will make in real life with a business. And the decision is whether Jenny should finance her business with a loan, borrowing from a bank, or with equity, that is getting some friends, some family, or external investors to give her the money, and then she will share the profits with them. This is what a cash flow statement looks like. This is the real cash flow statement for the Estee Lauder company. On the companies I manage, I find this useless. There's nothing that you can really do when you look at a statement like this. What I do is I typically pick 3 to 5 or 7 lines for us to focus on. If you have listened to my previous recordings, you will know that on the balance sheet, I will typically look at receivables, inventory, and other items depending on the industry. So no, don't worry about it. This is not what we're going to be doing. You won't have to listen to me talking about something like that. In fact, you will see that it'll be very important to learn how to make use of a cash flow with this real life example. Jenny needs the $15,000 to buy the shoes that she's going to sell during Christmas. Now, she can borrow from a bank or she can get an investor. Before going through the slides, what do you think she should do? And here's a QR code, and you can scan it and respond. You will see how other people have responded. When I was recording this, it was about 40-60, the ratio. Now, let's divide the decision in two different ways. One is if a business goes well, and you see here all the happy faces and people celebrating. And remember this, it'll be important for your understanding of cash flow. So in this case, this is what Jenny would have done if she would have borrowed from a bank. She would have gone to the bank and said that she needed $15,000 for inventory. She will borrow that amount from the bank and she will pay $1,500 or 10% of interest. Now, she will also have expenses of running the business, which are normal. The second thing is what will have happened on December, at the end of December, with her profit and loss or income statement. She would have sold all the 50 pairs of shoes at $1,000, so her sales will be $50,000. Her cost was her inventory of $15,000, and then she will have to pay the 10% interest plus the expenses that she had for 5 months of $4,300 or $21,500 in total. So once you add it all up, from a profit and loss point of view, she would have made in total $12,000. Now, when we look into the balance sheet or the cash flow, we see that with the money that she got, the $15,000, she would have paid her debt, including interest and all the other expenses, and she will be left with a cash of $12,000, the same number that her net income of $12,000. So this is what would have happened if business went well and Jenny borrowed from a bank. Now let's see what happens if instead of borrowing from a bank, she gets an equity investor and the business goes well. So for August, it'll be the same situation, right? She will get the $15,000, this time from an investor, and she will use the money to get the inventory for her business. When we look at the December P&L, it will be a bit better. So she sold 50 pairs of shoes at $1,000. This was her cost of sales, and these were her expenses. But because she didn't pay interest to the bank, her net income was higher. In this case, it's now $13,500. But let's see now what happens to the balance sheet and how much cash she gets to keep. So with this $50,000, she's able to pay the cost and all her expenses, and she's left with this cash of $13,500. But the trick is, though, that she doesn't get to keep the full amount. She only gets to keep 1/2 of that because her investor gave her the money, took the risk, but they agreed that they would share the profitability 50-50. So by having received an equity investor, she would have lost 1/2 of her cash or net income. So it wouldn't have been a good decision in this case where the business went well. What happens now if a business doesn't go well? Look at her face. She's looking all sad and so on. Remember that in the other scenario, they were all celebrating and looking happy and so on. And you will see that, depending on how the business performs, whether it was the right decision to borrow from a bank or get an equity investor, it changes drastically. Look at her face. Remember that I was saying before that when the business went well, we were looking at people celebrating and so on. In this case, you can see how sad she looks. This is the case where the business doesn't go well. And let's see what happens to the decision that we made to borrow from a bank or get an equity investors. First, let's imagine that she borrows from a bank the $15,000, but she only sells 10 pairs of shoes, not 50. So back in the beginning, she bought the 50 pairs of shoes from her supplier, and she borrowed from the bank the $15,000, and she agreed to pay interest. Now, in December, she only sells 10 pairs of shoes at $1,000. So her sales are 10,000, her cost is 3,000, but her expenses are still the 21,500 and the interest. So she has a loss, not a net income, of $16,000. She still has 40 pairs of shoes in inventory, but she cannot sell them. So that is an issue. When we look at the December balance sheet, she only has $10,000 on cash, plus the 40 pairs of shoes at $300 each, but she owes the payables and the debt. So because she owes more money than she's able to pay, she was bankrupt. Now, depending on where you are, that will imply how bad it is. Relatively speaking, in the US, it's relatively easier to go bankrupt. Unlike Europe or Asia, it's not perceived as being, a failure. It's something that, will stay in your credit report for a number of years and so on, but you can move on. In Europe, in general, it's perceived more as a failure from a, social point of view, even if that may not be the case. And in some parts of the Middle East where I live, you go to jail, right? So it's really, really hard to go bankrupt. Now, let's look at the other scenario. Let's imagine that instead of borrowing from a bank, she gets an equity investor, and the same thing happens. She only sells 10 pairs of shoes. So in this case, what happened was that she got the $15,000 from the equity investor, which she used to buy the inventory. And then in December, same situation. She only sold 10 pairs of shoes. This was the cost. Her expenses were a bit lower, though, because she didn't have to pay interest. So her loss was $14,500. When we look at her balance sheet, she will have the $10,000 of cash, she will have the inventory, and she will have a loss. And she will still owe the $21,500. Her equity will be basically negative because she has lost money. So the lesson that we learned is that if the business doesn't go well, if the initiative that we have is unsuccessful, then Jenny or us were better off with equity because she can simply tell her friend that she's sorry and her friend will have to absorb that loss. If you live in the US and in some countries in Europe and Asia and Latin America, in the US, we have the SBA, which is an organization backed by the US government that gives loans to small businesses. So you could borrow money from your own savings, you could borrow from friends and family, or go through the SBA. The advantage of the SBA is that they will have lower interest rates than commercial banks, and it will be easier to borrow from them. Now, some people who go through the process will argue that there is a tremendous number of forms that you will have to fill in, including the business plan that I typically cover on chapter 10. But for you, the advantage of doing this is that you will have people trained to find out whether your business is doable or not. So I look at it as something positive, not as something negative. The fact that the bank doing the credit analysis will make sure or try to make sure that your business is doable. And the recommendation that I will give to you, and you can go through the slides and look at what I have written, is do not pay upfront fees to brokers that appear on the internet and they argue that they will facilitate the loan. In most cases, it's wasted money. I encourage you to deal directly with the SBA, and you have the link if you're using a printed version of these documents, or if not, you can just Google the SBA on their website.